Welcome to our today's episode. My name is brienndaku. Today, let's look at a cycle in wealth creation that depicts itself in everyone. It's important we appreciate the movement of our net worth, the movement, our footprint in the cycle of wealth creation, which ultimately replaces us in actively looking for money to fund our bills, and that is financial independence. This is the cycle. It begins with you. It begins with me, the person. And at that point, we need to look at what is available within this person that can be monetized, the ability to generate money. Because at the end of the day, you will not save if you don't have money. You will not invest if you don't have money. So, the main question here is money. Where is the money? Money is created by assets. Assets generate money. So, the person who is you shall determine our net worth at the beginning. By definition, net worth is your wealth or your balance of assets after liabilities or obligations. At the point of start, as a person, your net worth will include the following. Before we enlist, we have to look at what is an asset, because in defining what net worth is, we have talked of the balance of assets after netting liabilities or your obligations. So what is an asset? And an asset would be anything of value, any resource that has ability to generate money. Anything that you have that has ability to generate money. You as a person, you have your abilities to make money. So you are the asset. You are the asset. And as a person, you have a net worth at 0.0. You have your own net worth. And it is that net worth, the assetness in you, the asset in you that starts making you money. So what assets do you have as a person? And number one, you have your skills or skill set. If you have many skills, you can identify your skills, whether acquired through academic systems, whether acquired through informal systems. Identify your skills. Then number two will be your time. Number three, we are looking at your energy or your good health. No wonder when you go looking for jobs, the first thing you will be asked for is a medical certification of good health. Even yourself, if you were to commit yourself into actively doing things to make money, your health will be very important. You can't work when you're sick. So that is an asset in you, your health. Then number four, we are looking at your influence or people. How many followers do you have in your Twitter handle? How many followers do you have in your Instagram? How many subscribers do you have in YouTube? How many followers do you have in TikTok? Facebook? That's a measure of influence, people around you. How many friends can you identify? They are part of your asset. Those are, you have identified skills, we have identified your time, we have identified your health or energy, we have identified people. Those are 4 clusters that you have in you. You have number 5, that is your talent. You have your talents, your abilities. So those 5 items can be monetized. You can combine your time and your energy, apply it to your skills, apply it to your talents, apply time and energy on people, and monetize to make money. You will use your skill, time, and energy and sell that skill set and time to an external person and become an employee. And by so doing, you will earn money. So that is the first thing that you need to identify: the person, you, and your assets. That is your net worth. If you are looking academically as accountants or finance professionals on what will be your net worth, your balance of assets after liabilities are taken care of, at the very instant somebody can quickly dismiss an individual who doesn't have a job as having a negative net worth, because net worth will either be positive or negative, because every item has to be valued in monetary terms, where your asset items have a monetary value total, your liabilities, then when we take care or we deduct the liabilities from the asset total, the figure that we get is your balance, your wealth, your net worth. So it can either be negative or positive. But we need to widen the scope. It's not about the money that you have at any given point. It's about the ability in you as a person to make money. And that's why we are identifying the 5. Your skills, your time, your health or energy, your talents, and people. Those ones you can monetize and make money. So there is an asset in that which we may not give a value. We may not give it a monetary value. But all those things can be monetized. You can monetize the knowledge that you have. You can share knowledge. You can educate. You can share your knowledge on social platforms and monetize that. You can share a skill, an informal skill, cooking, and monetize it on social platforms. So there is the asset in you that is very important, because most people, when we talk of financial literacy, it's many areas people talk about saving, investing, saving, investing. And saving, investing has to be funded by money. So many of us are left aside because the money aspect is not talked about often. So we feel we are not in the category to save and invest because the money element is not there. But the real thing is that the money that you are saving, the money that you are investing, actually comes from your active 5 or 8 to 9. What you do actively as a person, what you monetize. When you monetize your skills, either self-employ yourself or sell your skill and time and energy to other persons and get employed, and you start making money. Establish an enterprise for yourself. Establish a business, then start making money. So the most important person in this equation of wealth creation, in this journey of financial independence, in the cycle of wealth creation that we are discussing out here, is the person who is you. And that's why I'm taking a lot of time in dwelling on you. It is your active incomes when you have time, when you have good health, you have your skill sets, whether formal or informal, that you apply. Actively generate money. Expand your territories. Expand your incomes. Make streams that are possible. Even if one stream of income and you expand it, generate money. That is the most important thing in wealth creation. There must be money, and this money originates from you, the asset that is you. Remember, money is spiritual. It doesn't matter the spirituality that you profess. Money is spiritual. For those who profess Christianity and whatever, it is clearly said, and the truth is that the work of your hands will be blessed. The work of your hands will be blessed. Fold your sleeves, get your hands dirty. Be active, make money. Make money. Because all the financial literacy that has been shared, it begins from saving and investing. But there is no saving and investing if there is no money. And that money has to be created by you. You are aware now, you have your skill sets, you have your time, you have your health, you have people, you have your talents. Monetize. You have a good voice. Monetize that voice. You can be a good MC. Monetize. Identify your abilities, the talents, the skills, and monetize that. Make money. Because money is number 2 in the cycle. So for money, we have our expenses. And expenses form part of your net worth. We are making money to cover our expenses first. The question of control. You are the person who is making the money. You know how much you are making. You know the limits that you have, how much you can expand your incomes. So therefore, it is in your control to tailor a lifestyle that can be covered by your incomes. You stretch the garment depending on the material that you have. The question of budgets is out of today's episode because we have the ability to generate the money. We are the ones who are making the money. So we will tailor a lifestyle. We will spend this money in the knowledge that what we remain with after spending, what we don't spend, that is what becomes our wealth. What you don't spend, that is your wealth. Or wealth is the money that you don't spend. It is important we note that, or we get cognizant that at some point in our life cycle, it's a cycle because we keep changing. We are moving. You are a baby, you commuted to a teenage, you became adult, you got married, now you are still moving. Soon you are getting old enough that you can't actively make money. You can't monetize that energy because the energy will be drained. You are old. And it is that point where you are old that we are looking at how your active time, the energy that you have today, how will you use it? Where will you store that energy so that when you are old, the energy that you have today, you will have stored it somewhere to take care of you when you are old. That one aside, it is a choice, it's a personal choice on when and how you would want to switch from waking up every morning knowing that you are going out to do anything available, expend your energy to make money to settle your bills. You can make much money when you are energetic, when you have the time, when you have so many skills and assets in you that you can monetize. Pile money such that the amounts that you have piled will be enough to take care of you at a time of your choice. You don't have to be old to switch from active income, to switch from waking up every morning to look for money to pay your bills, to using the money that you have piled, the money that you have kept to take care of your bills for the rest of your life. It is a choice. When do you want to switch from active to passive income? Active income is cash inflows that you earn out of your being actively involved to make money. And the best part is at the stage where you have to work to pay your bills, because you have to be active throughout your life. But in terms of your bills, when you are waking up every morning to settle your bills, meaning that if you don't work, then your bills will not be taken care of, and that becomes the main worry. That is a point, that is a period of our time that we want to take care of. We want to save money, put this money in opportunities, and keep increasing it so that at our chosen time, the money that we have kept will be enough to take care of our bills. So that at that point, we switch from doing things because of our bills to adding value, doing things that we like, doing things that we love, even if for free, because our bills are taken care of. We get freed from waking up every morning to look for money because of our bills. We acquire that freedom to pursue life, to enjoy life, because our worry about money because of our bills has already been sorted. Not by anybody else. We have sorted that one by consciously, deliberately setting goals, deliberately identifying a time, and within this time frame, piling money into opportunities so that from that particular time that we have chosen, we will be free from working for bills. So there's that aspect of a goal, that freedom, the freedom from working for bills is a goal, and all goals must be smart. That goal is specific. You have specified that our intention here, we are pursuing financial independence. We are pursuing financial freedom. So we sacrifice, we tailor a lifestyle that leaves a lot of money unspent. We pile a lot of money when we are active. We pile a lot of money when we don't have a lot of responsibilities. We keep that money, and systems work to increase the money so that at our chosen time, this money will be so much that it will take care of our bills. So, being that specific, we will look at possibility. Let these possibility of achieving the specific goal. So we are going to make sure that our goal can be measured. Let this goal be measurable. Let's know how much money is it. How much of this money do we require? What is the size of the money in terms of investment or assets? What we will call an asset will be a conversion of money into another form. Investing is converting your cash, liquid money, into another form. You have 100,000 in cash. You convert it into an asset called a bond. You purchase a bond worth 100,000. You have your 50,000. You purchase a treasury bill or a bond worth 50,000. So you have a bond of 100,000. You have another one of 50,000. So your cash which was 150,000, you have converted it to another item, a bond of 100,000, another bond of 50,000. So assets, it's our cash that we have converted. So when I'm saying we are piling our cash, we are piling money, it is the same money that we will convert into assets, these items that are generating money. And we shall have reasons for that. So we are saying let the goal be measurable. Let's know how much money we will require to pile in order to get what we are looking for. And that is a moving goal. Because, for example, if you are now earning 30,000, if you are living expensive, you are leading a lifestyle of 30,000 on a monthly basis, you need, if you could get an opportunity or a stream that gives you 30,000 on a monthly basis for the rest of your life, then it means you don't need to wake up because of your bills. Your bills are already sorted, but because you must wake up. You will wake up to pursue things that you enjoy, things that you like. So, for measurability, for this person who needs 30,000, we look at a whole year. What does this person require? He requires 360,000, which is 30,000 multiplied by 12 months in a year. You get 360,000. This 360,000 is the total that this person would require in a year. Meaning that if this person will get 360,000, he or she will put it into an account, from which account he or she will be drawing down 30,000 every month. At the end of the year, as the account goes to zero, he will receive another 360,000 from the pool of assets, those bonds, those treasury bills, the dividends from shares, some income from a rental property that he builds. Then transfer that total again to that account from which they make their drawdowns. So the 360,000, we have to look at what is the size of assets that will be required enough to give us 360,000. I know if it is bonds, they will pay us 2 times in a year. Short-term bills will pay us the coupon and the redeemed amounts. Rent, if it's a property, it will give us monthly income. But it's a pool. We need to look at how do we raise the 360,000. So assuming we are getting a payout at once in a year, then assume a reasonable rate of return. I'm using 10%, an average that is common in the industry, common in our capital markets. We'll still, because of the fluctuations, sometimes going highs of 18%, other times loss of 7%. We look at an average. 10% can be gotten in the market throughout. So, if we are looking for 360,000, would roughly need 3.6 million worth of investments, worth of asset, cash generating assets to give us 360 that we require for a whole year. So now it's a question of this person who is earning 30,000, how long will it take them to achieve the 3.6 million worth of assets? So that's why we are saying that this goal be smart. We have said it is specific. We want financial independence. And our independence will be achieved or acquired by a pool of assets of worth 3.6 million. So specificity of that goal is that we need 3.6 million worth of assets, cash generating assets. Then measurability is that those assets, we have measured them in monetary terms. It's 3.6 million. So now the third one, quality of that goal is achievable. Is it achievable? Yes, it is. Because it has to be within the abilities of the person we are talking about. If you are working, there you have to identify other avenues of generating money. What else can you monetize? What side hustles can you do to bring money? Because at the end of the day, we must make sure we achieve our goal, that is financial freedom. So once it's money, then we have to make sure it is realistic. It's real. It has to be a realistic goal. Then time is a factor. If you don't have the element of time, the question of how long it should take you to achieve that goal, then anytime you achieve it becomes unnecessary. And that's why people work forever. I wish you could see the panic in some individuals when they are issued with their terminal leave letters. And if it is a public servant, that person from the very first payslip, it indicated their date, their year of retire. So they knew when they will retire from the beginning. But look at their surprise and shock that strikes most people when they receive their terminal letters, their retirement letters. It's a shock. But they failed to take their financial independence as a goal that should be specific. They never measured it. They never made it achievable. It wasn't realistic because it's not there. And they didn't set their time. You get a person who is retiring and they have a debt, a loan that is being recovered up to their last payslip. There is a deduction. There is a loan deduction. It's not a question of lack of financial literacy. It's a question of lack of choice. A person who never decided, being indecisive. So once you have made that goal, it is the goal that pushes you to expand your incomes. If there are no possibilities of expanding your income, then that is when it comes, you are pushed into squeezing or reducing your expenses, managing your expenses, managing your lifestyle in such a way that you leave enough money to set aside and spend to pile up to the amount that you require to be financially free or independent at the time of your choice. I know somebody is almost asking me, don't I appreciate compounding, the interest that coming out of that pooling? Yes, I do. But the point, remember, we have issues of taxation. We have so many expenses that come with investing. If you dwell on the interest when you are piling your money, you will get lost. And that is one of the easy mistake that most beginners in investing are doing, or they do. And that's how they quickly lose their interest in investment, because they are looking at the return. The essence of interest and dividends, the returns. You are already working. You are taking care of your bills. What nonsense do you have about the return? Look at the surprise that I get with many investors in circles. Immediately, the AGMs declare the dividends. It's like all members want their dividends wired by M-Pesa and other mobile platforms. They just want to consume the return, forgetting this return. Our goal is to pile money. Whatever comes out of this investment need to be part of the piling, because compounding is a descriptive aspect in investment where your return, that interest, that dividend forms part of the investment. We shall only work on our return at our point of financial independence. At that time, we have chosen to be financially free. That is now when the interest and the returns become necessary for our consumption, because that is what is taking care of our bills now. Those are the fruits that we are eating Those are the fruits that are taking care of our bills. The tree that is bearing the fruit, that is our capital. You don't touch capital. You don't touch capital. You start a business, you stock the business. If you eat the capital, you are eating the business. The money that you are piling, that is our capital. That is the tree that we are planting. This tree matures, flourishes or flowers, buds, and fruits at the chosen time of our financial independence. Once we attain our 3.6 million that we earlier stated of a person who is earning 30,000, that is the time, because it is only at that time that we will be able to get enough fruits to cover our entire year. So interest and dividends that you are receiving from your investments are not for your eating. You have to identify the period that you are taking to accumulate capital, the period that you will take to achieve your goal of independence. Throughout that period, the capital that you are piling and the returns that are coming out of those investments, compounding, they should not be touched. You shall only harvest the fruits of this tree we are calling capital once it matures. The moment you start consuming your interest, consuming your dividend in the period where you are supposed to be investing, your goal as time is time framed. Within that time, don't touch that interest, don't touch that dividend. Keep reinvesting. Let it be part of your capital. Let that interest and dividend acquire more assets. When interest and dividends, when the returns go out to make you more money with what you had set aside from your active income, that is the time we talk of compounding. So if you eat your interest and dividend, you have eaten the miracle of investments. That is compounding. So compounding integrates with the investment. Don't eat your interest, don't eat your dividend, unless you have achieved your target. There is a method that we use of blow by blow investing for passive incomes. You identify your living expenses. Rent is 10,000. So in a whole year, I need 120,000. So how much of investment do I require in order to get 120,000? That to be in a 10% environment, that will be 1.2 million. So you go flat out to build a 1.2 million portfolio or asset. You acquire bills, you ladder bonds to a tune of 1.2 million. At 10%, you are getting your 120,000. You have already achieved that goal. So if you are able to achieve that in 1 year, the 120,000, that was specifically, that is a portfolio that was built specifically to take care of your rent. So start consuming it. Start covering your rent out of that one. You are good. Because you have taken your time as you had planned. You have achieved the goal. The tree has matured. The fruits are here with you. Channel that income to that. Identify another item. That is water, electricity. That may be costing you 3,000 in a month. That requires 36,000. How much do you need of capital to gain 36,000 in a year? That is 360,000. You give it a period of time. You go flat out. You either save, reduce your expenses, or you aggressively look for more money, because there are two ways in which you can increase your income. The first line of your income generation is your lifestyle. If you reduce your lifestyle, if you move from a 20,000 rent to 10,000 rent, you have already created an indirect income of 10,000. So if you reduce your expenses deliberately, identifying a certain amount of money that you need to save, because mostly we reduce our expenses and still consume, find another vote, another time to spend the money. If you're reducing your expenses purposely for investing, you identify that amount and channel it to a specific investment. So, reducing expenses gives you an indirect income. And the other way is you aggressively look for other opportunities to monetize or make money. You can get a side hustle, you can monetize a talent, you can monetize a skill, you can monetize people. How? Your followers in your TikTok account, you can monetize that traffic. Your followers in YouTube, you can monetize all those streams. So you have two ways you are expanding your income: aggressively looking for more ways to actively generate money, and defensively by reducing your expenses. If you combine the two, there is a synergy. If you harness the synergy of combining aggressive approach and defensive approach of increasing your income, good for you. You're going to achieve your goals earlier or faster than you expected. So, by so doing, we have taken care of the expenditure and the income that form part of your net worth. A huge subject, net worth. You have to know your net worth. You have to know net worth, because your net worth determination is your method of measuring progress, because it is a journey. This cycle is a journey. It moves from you, the original asset that is making money, and this asset has assets around it, which we have identified: your skills, your talents, your time, your energy, your money, because you have actively started generating money. The money that you accumulate becomes now part of it. Your incomes, your expenses, people, all those are items that encompass the asset that is you, that is in you. That is the most important asset, because it generates money. Then once we are now able to make money, the rest is a flow. You make money actively. This money is translated or converted. Business is converting money to another form, then reconverting it back to money with an additional amount on top, which you can either call a return, a profit, or whichever name you can want to call the markup, the amount above what you put. For example, if you take 10,000 and you purchase merchandise for sale, the merchandise name changes to stock. So you had 10,000 liquid cash, which you have converted into a commodity you have called stock. Money has changed form. You have converted that money. Then to this stock you add a profit, a markup. Instead of 10,000, you are selling it at 15,000, 12,000, 13,000, depending on your markup rate. So when you sell the stock, you will receive your 15,000. The stock has now been converted again back to cash. And the cash that has coming in, compared with what we had originally, we had 10,000 and here comes in 15,000. Business, we have made a profit of 5,000. This 5,000 goes into our basket of accumulation to buy either additional stock. It can go to a money market fund. It can go to another, either to a circle. It will acquire a different asset. When you have more than one asset, you have your stock in business, then you have a bond that you have purchased, you have a treasury bill, you have a portfolio. A portfolio is a collection of assets that are generating money. I've decided to explain portfolio because I have a subscriber who was asking me about portfolio. So a portfolio is a collection of assets that are generating money for you. So when you say build your portfolio, is a collection of assets. And a collection of assets will also be called wealth. So wealth is portfolio. Your wealth can be divided into groups, into different portfolios. So business, money, once we have piled our money, Now we get into the process of converting our money into assets, into items of value that are generating money. That can be done simultaneously with the accumulation. You accumulate 100,000, you buy a bond. You accumulate another 100,000, you buy another bond. You accumulate an amount, it is in an emergency fund, either in a money market fund, either as an emergency fund or as another form of investing. You accumulate some money, you put it to equities, you buy stocks. You accumulate, you choose where to keep that money. And that is the aspect, that is what we call saving. Saving is preventing your money from loss. And the easiest way to lose your money, using it. So to save is to prevent your money from spending, from being spent. So you keep. And that's why saving is the first element, the first important step to wealth creation. What you don't spend, that is your wealth. And that is the entire question about money. To save, prevent your money from being spent, from losing its value, and from getting lost. Three things. To save, you are preventing your money from getting lost. So you look for a place to keep your money that is safe. You are preventing your money from losing its value, its ability to purchase. If what you are saving can get you whatever it is able to purchase at the time you are saving, you should maintain that, prevent it from losing its ability to purchase. Then the third is you prevent that money from being spent. The aspect of saving goes beyond money. You will save your time. Your saving is about resources. You will save the resource of time. Apply your time wisely in generating money. And you also save on your health, your energy. The saved money, what we are keeping, what we are piling, you have to choose an account where to keep our money that gives us an interest return that is more than the prevailing inflation rate, because inflation is what reduces the purchasing power of our money. It's what depreciates our money. So to guard our money from depreciating, because depreciation, inflation is a must. So what you do, you look for an account that pays you interest on that money that is more than what you are losing through inflation. A compensation. You compensate for the value that is lost. So it's important for you to know the existing, the prevailing inflation rates were in your effort in choosing where to keep your money. There are other factors. Remember, we have said in the time of our accumulation, we have to protect, to save our money against loss. So the other way we are going to lose our money are distractions that happen in life. If you get a sickness, either you get sick or one of your loved ones gets sick, you will be forced to liquidate or sell an asset that you had acquired, converted your money into, and you intended to retain that asset, to keep that asset for the long term. So to prevent that one, you accumulate some money somewhere as an effort to take care of such emergencies. But the emergency fund aspect, that is an aspect of peace of mind. You know, you have ways that you have established to take care of happenings that you are not prepared for, or unplanned events. So what you do is you procure. That is a risk. There's a risk, an happening, an unplanned happening, an anticipated occurrence. That is a risk. transfer that risk if you can't manage it. I don't know the kind of sickness that can strike. There are some sort of ailments that once they strike, is a huge hammer that distorts your entire life. What do? I transfer risks that I cannot manage. That's why I will procure a medical cover. If my employer has a medical cover, I'm safe on the line of sickness. I will procure a medical cover for that. So the aspect of money is just we convert this money. That is our stage 2. We made the money the original asset. Now we have the money and we have converted the money, because I've said you can do this simultaneously. Once you accumulate a little, you convert it into an asset. So we have now in stage 3 where we have assets. We have amassed bonds. We have treasury bills. For those who are risk lovers, they have commercial papers. We have purchased equity. We have purchased stocks, shares, the other name, equity instruments. While at that point, shares, or for those who we buy shares. A person like me, I've tested myself in business and I failed terribly. But I still know back in my mind, business, enterprise, entrepreneurship, business is the easiest way of creating wealth. So what do? Because I've tested myself and I found that when I put my hands in the business, I'm not able. I'm not good at business. Then I identify businesses that are doing well. I identify those businesses and I buy a portion of the business. Acquiring a share or share capital, buying shares of companies, you are buying a part of that business. You are owning a part of that business. So if I'm unable to build a business on my own, I can buy into other people's business. So those assets, when you put them together, that is your wealth. Wealth becomes stage 4. That is wealth. So wealth is collection of your assets. We aid you the original asset, that must be protected. All assets must be protected because they are the ones that are generating money. So the asset that was you made money. This money we have converted. So investing is just converting the money that you piled into assets. Then the assets we amass, or we increase the number of the assets, they become our wealth. So where do we attach importance? Is it the assets? Is it the wealth? Is it money? We attach value on you, the original creator of the money. So don't look at the interest, don't look at the savings. Look at yourself and look at what you can do. Sharpen your skills. Expand your skills. Keep increasing your influence. Look at the traffic in your social media. Convert that traffic into business. Look at your talents. Monetize that talent. Take care of your health. Your health is part of your health. Take care of your health. You cannot enjoy your wealth in bad health. We have time. Manage that time. You are the most important asset in wealth creation. Then all the rest in the cycle, once we have amassed assets, remember you are an asset that was originally making money. Now you have amassed a huge list, huge cluster of assets. So you are an asset, you have made other assets. When these assets that you have created, the wealth, the pool of wealth, is generating money that can cover all your expenses, the original assets. At that point, you can make a decision to switch to other things because your assets, these assets have replaced the original assets in generation of revenue or cash flows to fund bills, your lifestyle. That is the time we say you are financially independent. You are financially independent. When you have amassed enough assets, enough because they are generating enough cash inflows to cover all your expenses, so they can replace you in generation of income, you are financially free. So financial freedom, financial independence is a process of you building assets to replace yourself in generation of cash flows for your lifestyle and other bills. I find all that information very important, and I appreciate my 600 followers to date. If you are new to this channel, I request you to subscribe. Give a thumbs up to this good information. Give me a comment in the comment section and share. Sharing this kind of information improves our society. It improves our knowledge. It empowers us in wealth creation. Making a better society for all of us. But sharing, liking, and commenting on this video build up parameters that will be used by the algorithm to share this information or the video to other people. Thank you for your time.